Hello everyone, welcome to the fifth episode of Outsourced CFO's most common gap analysis risks. My name is Uwais Asmal and I'm the head of advisory services at Outsourced CFO. As a business, Outsourced CFO has performed many financial gap analysis over the years for many different companies. And what we've realized is that generally the same issues keep cropping up. So this series of videos is to share with you some of those common risks and errors in the hope that you can resolve them going forward. Tax. A lot of businesses, once you start your business the first few years, you might be making a loss. And in theory, you can use that loss to reduce your taxes in the future. But businesses forget about these assessed losses and then they pay too much tax going forward. That's something that you need to consider in the years that you start being profitable. Make sure you use the losses that you incurred in the previous years to reduce your current tax payments. Sometimes the business is not doing sufficient tax planning. Uh, for example, there's a small, if your business qualifies as a small business corporation, the tax rate is much lower. Have you discussed this with your tax consultant, with your accountant? You might be able to save a lot of money in terms of taxes that you don't need to pay. Maybe you've been paying too much tax to SARS. And these are legal, ethical ways not to pay so much tax. Another thing that happens is when you start a business, you don't necessarily register for SDL. But as soon as you start paying out 500, at least your salaries come to 500,000 Rand a year, you need to pay SDL, which is a skills development levy. If you haven't, you need to start paying now. SARS will most likely back charge you from when you started reaching 500,000, and they're going to charge you interest. So the sooner you pay that and get that sorted, the less interest you're going to pay. Also, if you're making on average R1 million a year from revenue, which works out to 83,000 Rand a month, you are required to register as a VAT vendor. And if you haven't registered as a VAT vendor, SARS is going to charge you. And what they do is they would just work out 12 months going backwards. And if you haven't registered properly, they're going to charge you penalties and interest. So make sure you register for VAT in the time that you need to. Some businesses have just not paid their income taxes, or they haven't registered for PAYE. And that's a massive risk because, again, SARS is going to levy penalties and interest on you. And also, you won't be able to get a tax clearance. And if you don't get a tax clearance, you won't be able to apply for funding. You won't ever be able to sell your business because your business is not compliant. So you need to make sure you have a tax clearance for your business. And it's not like it used to be previously where you could get a tax clearance once a year. Now your tax clearance can be checked at any stage in the year by anyone. And if you're not compliant, you might lose business. Debtors. A lot of businesses have very poor debtor management. They have some of their key customers because of relationships where they've got long outstanding debt, and cash is king. If you don't have the cash, you can't run your business. What happens is that sometimes invoice payments are received, but they're not allocated to the correct invoices. So maybe your customers actually paid you, but you still think they owe you because somebody hasn't allocated it correctly. I know it seems like a small thing, but it can trip you up. Or sometimes your payment terms are bad. For example, you might have 90-day payment terms for debtors, but most of your suppliers need to be paid within 30 days. When your employees obviously need to be paid within 30 days. So you're paying your expenses much sooner than your money is coming in. Now you have to get an overdraft, and there's a cost to that. So you need to check your payment terms so that it ties into the rest of your working capital cycle. Does it currently tie in? Sometimes revenue recognition is incorrect, especially when it comes to exporting and importing, and you need to have a look at that just to make sure your timing is correct, because you might be paying tax too early or paying tax too late. You need to consider things like that. And then lastly, the last section is creditors. Again, similar to debtors, payments are sometimes incorrectly allocated, and you don't realize you've actually paid a creditor and they're still showing as outstanding. And then you end up paying the creditor twice. And that's a cash flow issue. You can't make that mistake because you're giving money away. And sometimes to get that money back, the effort that it requires to get that money back is just not worth it. Or sometimes you just have, you've received a service from a supplier, but you haven't recorded that invoice yet. And yes, you may think you're saving cash, but your supplier, you're going to have a very unhappy supplier, and that might lead to the close of your business in the long run if your suppliers are not happy with you. Also, sometimes management doesn't consider paying early. Why would you pay early, you might ask? Sometimes suppliers would, for example, give you a 2% or a 5% discount if you pay within 10 days as opposed to the normal 30 days. Check if they've got early payment discounts, because that might be beneficial to you when you consider your other cash. If you've got the cash flow, you might as well pay less for your stock, as an example. And that's it for this week's episode. I hope that it helped. Thanks.
Hey, Lau here, one of the founders of Outsourced CFO. If you enjoyed this video, make it official. Click subscribe.